Hello, I'm Ryan Schneck. Equities performed well in 2016 for the most part. Some market segments, like U.S. small caps, had a phenomenal year. Others, like Europe, struggled. Wide gaps between the top and bottom performers often spark questions about the merits of owning the laggards or why we don't hold a larger position in the leaders. When confronted with these performance disparities, it's worth revisiting why we commit to a total portfolio investment approach rather than concentrating in U.S. stocks. Well, you wouldn't want to heavily concentrate your portfolio in any one asset, regardless of how familiar or comfortable that asset might feel, as is often the case with U.S. stocks. Of course, I'm talking about the critically important investment principle of diversification. We put a great deal of effort into determining the right mix of assets for every investment portfolio. And the truth is, once established, that mix of assets really shouldn't change dramatically from year to year, unless one of two things happens. The investor's goals and objectives materially change, or the markets or our expectations for market behavior undergo a structural change. And that brings us to another critically important principle of investing: discipline. The ability to stay the course in the face of temptation, because making decisions while looking in the rearview mirror just doesn't work. The U.S. constitutes about half of the global equity market. Our equity portfolios are roughly in line with this weighting, so U.S. stocks are already the largest exposure by a significant margin. But consider that investors tend to favor equities listed in their own home country rather than those listed internationally. In the investment world, we call this home country bias, and reflecting a small amount of this natural tendency in a portfolio is not necessarily a bad thing, especially if it helps investors maintain discipline. However, allowing our biases too much influence can impair the diversification of the portfolio and lead to unnecessary additional risk. Investors sometimes also wonder why we couldn't just own large U.S. companies that provide indirect exposure to international markets. Obviously, we can and do hold large U.S. multinationals. But to expect these companies to serve as our entire international equity exposure would be leaving a lot of opportunity on the table. If U.S. companies represent half the global equity market, then barring international companies would ignore the other half of the world's equity markets. In fact, large U.S. companies provide international exposure precisely because they're pursuing overseas business opportunities. The U.S. is a more mature market, so growth prospects can be lower at home compared to some markets that are still developing. Having an allocation to international stocks essentially follows the lead of U.S. multinationals by exposing investors directly to diverse markets with attractive opportunities for growth. The last few years have seen an unusually strong run of relative performance for U.S. large caps. But as you can see, this is not the norm, and making decisions based solely on recent performance amounts to performance chasing. In any given year, there will be an asset that outperforms the diversified portfolio. The trouble is, no one can consistently predict which one it will be. And piggybacking on last year's winner has historically left investors worse off in the long run than if they had just stayed put in a diversified portfolio. Or as we like to say, a well-diversified portfolio is the best path to long-term success. To conclude, no one knows how domestic or international equities will perform as a standalone asset in any given year. Fundamentally, we believe optimal risk-adjusted returns are best achieved over the long term with a globally diversified investment portfolio. Thank you.